And heading back over to the dark side, we have Mark Potter, and go for it, Mark.
Thanks, Anthony. Well, now we're back on the share side. I'd like to say that I think the worm is turning back in our favour. And look, I think that was just really blind optimism from Emma. I don't think it was really thought out in any concise manner. What investors want to do, they want to make money. Investors want to look at, if we're going to make money, we know we always need to take into account where should I invest, and to do that we need to look at where we are now. The fact is, Australian residential property is currently at record highs. The share market, mind you, can improve around 45 to 50% from current levels to make new highs, as it always has. We believe that Australian share investments have a significant period of outperformance ahead of them relative to residential property. At the same time, you have a higher rate of overall income with franking credits attached. Property in Australia is very expensive on virtually all measures at the current time. Compared to the UK and the US, Australian property is between 35 and 135% more expensive based on the average mean incomes of the household families. Based on the long-term trend, Australian property prices are 30% above that trend. Do you want to buy something that's 30% above trend? We say to property investors, be careful. Direct property investment is often out of reach, and many investors only get in there by employing significant leverage against that asset. These conditions in themselves helped bring about the global financial crisis. Blind optimism from US property prices, who believed that property could only continue to rise, employed significant increasing leverage into a rising market with serious consequences for the whole of the world and their own balance sheets, when property prices eventually came crashing down. So let's look at Australian shares, because there's no salt damp in our portfolio. Let's get the negatives out of the way. 1 out of 3 years on average, you will have the potential for a loss of capital, but the long-term returns are exceptional. Between the end of '86 and the end of 2009, a portfolio reinvesting its dividends increased over 8 times in value, just by investing the All Ordinaries Index and riding through all the bumps and swings. But let's not get complacent. But also, because that's a long-term period. But mind you, it includes 2 of the biggest crashes the market has ever had. The '87 crash and the global financial crisis of 2008. So the message is, you get recessions. You have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets and you'll be prone to making bad decisions. And that's why you should find a good stockbroker to help you with the journey, because it's not a sprint, it's a marathon. And imagine taking out some of those bumps along the way. And you can do it. Shares are liquid. You have the ability to invest smaller amounts of money. You can temper your risk at times by having some of that money sitting on the sidelines when conditions are difficult, and be more aggressive when the conditions are right. You can do all this without paying large transaction costs and stamp duty and land tax and council rates and water rates and maintenance costs. So as an analogy to property with shares, you can sell off the bathroom, put it on the sidelines, reduce your debt at any stage, and all for a very small transaction cost with the money in your bank account in 3 working days. Thank you.
We only just got the gong in time. I feel mortally wounded, actually, Mark. Greg, I think we're, by the way, don't forget to vote. Greg Troughton, Real Estate Institute of South Australia, Chief Executive Officer.
Let me deal with a few things from the top. I think I heard Alan say shares are different. Well, I'm arguing different. They are, but property is definitely better. I think I heard Mark say it's out of reach. Well, that's why you have leverage. Look, I'm here. I don't want to talk about the facts and figures. My colleague here has talked about that already. There is definitely a potential for the future for property to continue to grow and grow. I want to talk about perception, and given that this is the showdown, I want to talk about some clangers. And when I talk about clangers, I'm talking about the share clangers. The clangers being risk, volatility and complexity. I'll leave complexity to last. I'm a bit of a simple boy with simple needs. Let's just talk about risk. I did wake up this morning and as Emma has pointed out, I was shocked. I was shocked to hear the Greece debt is going to impact on shares. I was shocked to hear the BP spill is going to cause some dramas. the GFC for the last 12, 18 months has been going on and on and on. The Australian resources sector has obviously taken a bit of a blow. So, look, there is enormous risk with shares. Let's talk about volatility. Mark talked about the ups and downs. I had swings and roundabouts, but at the end of the day, the rush you get with owning shares is not like the rush you get when your horses first pass the post at the Adelaide Cup. So I want to make that point quite clear here. Complexity. Now, I like to think I can deconstruct things, but I am absolutely mesmerised by the complexity of the share market. I live in a house. I do have all of those expenses, Mark, and I pay them willingly. At the end of the day, I'm absolutely perplexed by the put options, LPTs, margin calls, bull and bear, derivatives, all of those sorts of things. Look, let me just pay my water bill and I'll live happily ever after. Look, at the end of the day, I actually think that property is the source of all wealth, and yes, it's great to see the banks using that leverage for their shares. Property is the source of all wealth, and if I was to summarise in one word, I would say, show me a game that's been produced using wealth, property wealth, as the base of all the game. I guess that's property, long-term wealth. Let me show what shareholdings are like. Ups and downs. So the long and short of it is, simple boy, simple needs. I like to know that I don't turn the TV on in the morning to see how bad the shares have gone. I want to know that the house over my head is sound and will be there for the foreseeable future. So look, I think I've said all I want to say in terms of all of that, Anthony. So hopefully that concludes our side.
Well,
See, we don't even need 3 minutes.
no, well, it's a compelling argument. I'm convinced actually, but let's,
surprised.
well, I need to see what the rebuttal is, but I'm sure that it'll be boring. But we'll suffer it.